Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Is retail dead? No, but if you look at these earnings, you might think so. Dollar General down 32% yesterday after Q2 earnings that really disappointed and guidance that really disappointed as well. We'll talk about that and why that is. Stock is down 46% in the past 5 years. They've really struggled to work through their margin issues, and that continues to be the case. Then we'll talk about Ulta as well really quickly. Stock is flat for the month. Berkshire Hathaway bought the stock here, had a little boost, but that's very short lived as the stock is down about 9% pre market, kind of almost back to where it was pre boost. And I think it'll fall a bit more from here, but we'll look at those earnings as well and see which one is a more interesting buy, if any of them. Looking at Dollar General Q2 earnings, net sales increasing 4.2%. Doesn't seem that bad. Same store sales still up 0.5%. Not amazing, but at least it's growing. The problem is their margins continue to be pressured. EPS down 20.2% to $1.70. That's a pretty big drop year over year, and that's a problem. So what's driving that? Well, one, they blame it on the low end customer struggling. That's certainly the case. I think both of these stocks will show that the low end customer is struggling and the mid to high end customer is still doing well. You can look at Target, Walmart, Best Buy. Those earnings were pretty decent, so people are still spending money. And they're just not spending money as much at Dollar General. One of the things they mentioned during that call that was interesting is that the last week of the month is their worst week, which kind of shows that people are struggling to maintain their purchasing power throughout the month. They're running out of money. They're having to cut back towards the end of the month. The other problem for a company like Dollar General is that their growth is coming mainly from consumables, and that's a lower margin item for them in 2021, 2022, when this company was still doing pretty well as far as growth, as far as margins go, really well as far as margins go. Consumables made up something like 76% of their sales. Now, in this quarter, in this half year that we've seen, it's closer to 82%. So more and more expenses are going towards consumables, which are, again, a lower margin product. This is a company that is also adjusting their full year outlook for 2024 down from 6% growth on the bottom end to 4.7% growth on the bottom end, 5.3% growth on the top end from 6.7% growth on the top end. That's, not that huge a decrease, but the problem is they're dropping their EPS by quite a bit. Their previous range was 680 to 755. Now it's 550 to 620. Real pressure on the margin side. What is driving that? Well, one, their store experience is terrible. So people only go there when they have to. Their business model is basically we're going to build in areas where there's no other options. So if you're in a rural area, if you're in the middle of nowhere, there might be a couple of Dollar Generals around you. They drive all the other small businesses out of there, and they basically raise prices, you know, drop service, hire as little people as possible. So you've got boxes piling up in the middle of the aisle. The experience isn't very good. The store looks dilapidated on the inside, looks fine on the outside, so it draws you in. But when you go inside, it's not very good. It's just not good. It's just not a good retail experience. So for me, even without looking at the valuation, I've been to a couple of Dollar Generals, and I'm like, this place kind of sucks. Do I want to own a place that I think kind of sucks? Maybe if the valuation is good enough, but at the end of the day, that's something to consider. So on the margin side, they did talk about, hey, we need to hire more people, maybe a little bit, so that there's more than one person staffing an entire store. That would be a good idea, maybe. At the end of the day, that's going to drive costs up, and they're already seeing wage inflation from the understaffed stores that they already have. They're still planning to open quite a bit of stores. They have 2,400 real estate projects going on, 730 new openings, 1,600 remodels, some relocations. The interesting thing about this business is that their margins have also been pressured on the free cash flow side because their capex in the last couple of years has basically doubled. They're doing more remodels, still about the same amount of openings, but a lot more remodels, etc. And stuff costs more in general. If you have to remodel a store, it costs a lot more in 2024 than it did in 2019. And when you're a business that's working on relatively low margins like Dollar General, that is a problem, and that is something that I think is going to be hard to fix. I didn't love the call for this earnings. Company talks about here's all of the things we're doing well. Quite often, they're not really talking about the things that they're going to do to fix the problems ahead of them enough. And I think what's going to happen relatively soon, in my mind, is that management's going to be replaced. I think they're going to need a new CEO. You don't have a guy like this who's driving such a decrease in stock price stick around for too long, in my mind. I mean, look at what happened with Starbucks. I think they just need some fresh blood, some fresh ideas, because if you look at their growth here, it's really slowing down. This hasn't really been updated yet, but the problem here is evidently clear when you look at this is a business that had 5% free cash flow margins for a bunch of time. Now they're down into the low single digits. I think this is a bit overstated. I think these assumptions are a bit optimistic with what's happening with the business. On the net income side, kind of the same thing. You know, you're shrinking 200 to 300 basis points on your margin. And your growth is dropping into low single digits. So that's not a good sign. As we look at valuation here, disclaimer, video is purely for informational purposes only. It is not investment advice. Do your own due diligence. So I'm looking at valuation here. This is a company that was doing a bunch of buybacks, and basically they said for 2024 we're not going to do any more buybacks. Kind of a problem when your stock is at 5-year lows. You should be pumping more money into buybacks, but I think they want to retain financial flexibility, which isn't often a great sign for what's to come ahead. They still have some debt. They have a lot of capital leases on the book, so you can kind of see that their market cap is this. Debt is here to bring an enterprise value to 35 billion. Still not an amazing free cash flow yield based on what happened in the prior 12. If you look at it from a next 12-month basis, it's closer to 7%, which kind of gets more interesting. So this is sort of where this is an intriguing prospect, because if they can achieve 3% free cash flow yield in the next 12 months, that's a 6.6% free cash flow yield. That's about as low as the stock has traded on a free cash flow basis, even though their margins are compressed. Kind of interesting. So as I'm looking at the valuation here, expecting growth in the mid single digits this year, kind of dropping into low single digits. Expect free cash flow margins to kind of stay around 3%. Is that too optimistic? Let me know in the comments down below. Is that too pessimistic? Going back towards a buyback eventually, not this year, but starting in 2025. This is probably going to be a buyback story if this price stays depressed, and if they can achieve margins in that 3% range, should be good enough. They do pay a dividend, so keep that in mind. About half of their cash flow going out in the form of a dividend. As far as I know, they didn't raise it last year, but I do expect them to kind of raise it minimally for the next couple of years. Hopefully they don't cut it. That would be a big problem for investors. But at this point, it's paying a 2.8% dividend yield. If that grows in the low single digits, maybe you'll get a 3% cash yield based on today's prices if you buy in the future at 2% growth. So at the end of the day, that's kind of my assumptions here. You can play around with them if you will. Hit file, make a copy. The link to this spreadsheet will be down below. So 2.7 billion out of the 6 billion in free cash flow going out towards dividends. About 3.8 billion in excess free cash flow. They could certainly institute a higher buyback than what I'm showing here. What's the correct valuation for a company like this? Historically, they've traded in that 4 to 5% range. Maybe now that they're slowing, I need to up this up to a 6% yield, which kind of gets you to a fair value of $68. Right now, I have it in the 5% yield, which is a fair value of 81 bucks. So play around with the spreadsheet. With this 5% yield, I get an expected return of about 11.3%. That seems optimistic to me. Right now, the market's giving this a 6% yield, maybe even higher than that on a next 12-month basis. Should this be in the 6% free cash flow yield, that gets you an expected yield of about expected return rather of about 7.9%, inclusive of dividends. If I want a target return of 10% prior to dividends, gets me to a fair value of 68 bucks. A 7.5% return prior to dividends, or a 10% return after, gets me to a fair value of 76 bucks. Am I interested in buying something like this? No, I just don't like the product that they're offering right now. I don't see myself going into Dollar General and having a good experience. I don't see a lot of people going into a Dollar General and having a good experience. They go there because they have to. However, in a recession, historically, a company like this has done well, but right now, the low-end customer is pressured so much that I don't know if they'll do that well in the recession. However, that low-end customer might actually benefit from, unemployment, etc., depending on who comes into the presidential office in the next couple of months. Will food stamps go up? Customers like this depend on food stamps. That might benefit a company like Dollar General. So potential upside from here certainly exists. I think what this might be is a good long-term leaps play. If we saw what happened to the stock when a similar thing happened just maybe a year ago, the stock cratered from 160 to 100 bucks when I last made my video, and then kind of recovered pretty quickly to 160. So is a similar recovery ahead? For me, maybe that'll be worth a long-term leaps, like kind of a lotto play, but I don't know if I want to hold this stock long-term unless it trades probably closer to the 60s. Then I'd really consider something like a position in this stock. So that's my thoughts on Dollar General. Let me know what you think down below. Looking at Ulta, similar story here. Sales actually decreasing a little bit, or actually increasing rather a little bit quarter over quarter, but comparable sales down 1.2%. So new store openings really driving that increase. Margin pressure coming down as well, 15.5% operating margins. Last year, 12.9% this year. Their guidance is impacted as well. Prior outlook had them at 11.5 to 11.6 billion in net sales, down to 11 to 11.2. Comparable sales decreasing to no change. So kind of a problem here for a company like this. Margins also decreasing. So seeing the same thing here. Basically what they said on the call is there's a couple of factors. One, the low-end customer is struggling. The marquee brands, the high-end brands are still doing well. Competition is ramping up, and competition means that, hey, there's over 1,000 locations in the last 3 years that are opening next to where their stores are. A lot of competition out there. Because the high-end customer is the one that's doing well, those customers are more than likely going to stores like Sephora. They're less likely going to stores like Ulta. Ulta gets more of the low-end customer, which is struggling a little bit. They talked about how the beauty brand is slowing, with growth in the beauty brand down to 3%. In the beauty category rather, and this is a category that has been growing for quite some time at a decent clip, so that's coming to a slow, and that impacts a company like Ulta for sure, especially if that growth is even further cut on the low end customer. They still talked about brands like Elf, etc., doing relatively well. The growth is there. It's just some of their other low end brands are struggling. That combined with the competitive pressure, you can go Walmart, Target, CVS, etc., but other beauty stores as well to get your beauty products. And maybe if the low end customer is struggling, they're more than likely to just get their beauty products at other stores, or really cut back on the expenditures they make at a store like Ulta, which is really impacting them because they're seeing less of that customer. They're having to do some sales that they haven't been doing before, that's eating into their margins, not really improving sales as they expected them to. And that's a problem for a company like this one. And I don't think that's something that's going to change anytime soon, because the economy is not going to shift on a bubble. I mean, if anything, the economy right now is relatively strong. It's just that in certain pockets, like the low end customer, the economy is really pressuring those people quite a bit. And that's impacting businesses like Dollar General and impacting a good subset of the business that Ulta gets. Maybe Sephora is doing much better than Ulta. That's kind of the story that I'm getting out of this. As we look at valuation, when I last looked at the valuation here, I was a bit more optimistic. But again, I think this is going to be a buyback story as well. I think Dollar General could be a buyback story if the valuation gets interesting enough. I think this could be a buyback story as well. You can kind of see that this is a 6% free cash flow yield before the drop already. If we cut this by another 10%, the cash flow yield on a next 12-month basis is going to be closer to 6.5%, I would wager, 6.3%. So decent, fair free cash flow yield already as I look at the valuation on a go-forward basis. I do have to assume that growth is going to be pretty stale. Negative 1% growth for the year, 2% growth for the next couple of years. Margins are going to be in that 9 to 10% range. What's a fair free cash flow yield for a company like this one? I think the story here is going to be that they're still going to generate a bunch of free cash flow, even if their growth stalls or even shrinks a little bit. The margins here are going to be in that 9 to 10% range, hopefully growing throughout this period. They're going to put a ton of their money towards buybacks. I have 50% of their money going towards buybacks, maybe even more. I wouldn't be surprised if it's 75%. So if that's the case, the fair value gets higher because the buyback yield gets so interesting. If the market punishes this more, this could get really interesting from a valuation perspective. Right now, at a 6.5% free cash flow yield, it's just okay. The question is going to be, what's the correct valuation to assign to a company like this one? Right now, I have 75% and 6%, 25% and 5%. Gets to an expected return of about 8.6%. If I want a 10% target return, that's $346. That is higher than what it's trading at pre-market. However, I could completely see a company like this going down to 6% or even a 7% free cash flow yield. In that case, you're talking about fair values in that low 300s, high 200s range. For me, I think if this got into like the 8 to 9% free cash flow yield range, I'd get really interested. But that means another 20% off of pre-market prices, because then this would be a buyback story for me. You're getting an 8% yield on the buyback side as long as the stock price remains where it is. They could push a ton of money into buybacks, and then it would be a really interesting investment thesis just on that perspective alone. And the upside from return to growth, return to margin improvement, etc., would just be the cherry on top. It would be a similar thing for me on the Dollar General side. If this gets into the 8% free cash flow yield, that would be another 20% off of where it is today. Again, I would probably be interested because then it would be a buyback yield. I wouldn't have to worry as much about this business actually performing at an amazing clip. It would just be, hey, I'm going to buy back a lot of shares of the company, and if the business gets back to 3 to 4 to 5% margins, then this could be an amazing return potential company. But I just don't see that happening. But if you do, you can put, hey, I'm going to put a 5% margin in here, and the fair value is 60% higher than it is trading today. If you feel like somehow they can get back to those pre-2020 margins, then this could be an amazing company, an amazing compounder. Don't know if that's the case. Don't know if I believe that. But if they can get to 20% below where they're trading today, and I can get buyback yield that's very, very high, I could get potentially interested in this. I wouldn't even mind if they cut the dividend and say we're focusing on buybacks in that scenario, because that would be the way to play it. Same with Ulta. If they could get to an 8% free cash flow yield, ton of buybacks, could be an interesting story there as well. But for me right now, these are both stayaways. I think their focus is the low end customer, and I think a lot of signs point that customer is struggling and will continue to struggle for an extended period of time, and that will really hurt a business like these two. And I think Dollar in general is just kind of a crappy business. So those are my thoughts. What do you think? Let me know down below. Comment, like, subscribe, all of that good stuff. Thanks for watching. Bye.